If you think the United States is quietly falling apart while Europe catches up, you are being comforted by a story that makes you feel clever right before it steals your money. And here is the part nobody wants to say out loud. The strange dollar down headlines, the stock market still rising, the bond market behaving like it is trying to scream, none of it is a mystery. It is a controlled illusion designed to move risk, delay exits, and keep capital trapped where the system benefits most. This is not financial advice. This is financial education, and it is going to be uncomfortable because it deals with mechanisms, not motivation. In 2026, you are already exhausted. AI keeps shrinking jobs faster than anyone budgeted for. Rent keeps rising like it has a supernatural power. Your paycheck buys less than it did in 2019, even when inflation prints look better on screens. Meanwhile, the stock market keeps hitting highs, and the people at the top keep finding new ways to explain why you are still not winning. So let us talk about how the money actually moves, why it looks like it is fleeing the United States, why it rarely truly does, and how the same playbook keeps reappearing in different outfits. You have heard the simple version. Higher interest rates in the United States compared to Europe should make the dollar stronger. Higher yields should pull capital toward the higher return. So if the dollar is weak, people assume investors are abandoning America. That sounds logical until you look at what actually happens when you try to sell. Currency moves are not just about who wants to buy. They are about who can sell, who is trapped, who needs to exit, who is forced to hold, and who has the power to manufacture outcomes with leverage and liquidity. Let me start with a pain you already feel in your bones. In 2026, you do not need a theory to know purchasing power is damaged. You can feel it at the grocery store, and you can feel it when you renew insurance. But the financial news machine keeps feeding you a more emotional lie. It tells you that markets are pricing in risk and that your suffering is temporary. Then you look up and you see indexes rising again, while your life does not. That mismatch is not a glitch. It is the system doing its job. And here is the first cliffhanger you need to earn. When you hear that the dollar is down, you are being pushed toward the wrong conclusion about where the money is going, because dollar down does not automatically mean capital leaving. It can also mean something much more cynical. Capital leaving is limited, but the appearance of leaving is used to manage everyone else's behavior. First, let us break the naive interest rate story, the story that makes people feel safe because it sounds like math. Imagine you have $1 million. The United States offers close to 5% on a safe account. Europe offers 2%. On paper, it is obvious. You would send the $1 million to the place with the higher rate, earn the difference, and then sit back and collect. After 1 year, the United States gives you $50,000 in interest. Europe gives you $20,000. That is an extra $30,000 for doing nothing. So why would anyone ignore the obvious? The only honest answer is this: because real life is not a frictionless spreadsheet. There are currency risk costs. There are transaction costs. There are taxes, constraints, collateral rules, hedging costs, and above all, there is fear. And in 2026, fear is not abstract. Fear has been trained into markets by years of shocks: banks collapsing, funding markets freezing, insurers getting crushed by catastrophe claims, pensions underfunded, and AI quietly replacing the jobs you thought were middle-class secure. So when people say everyone sold the dollar, what you should ask is, who exactly sold, how much, and why did the selling not trigger the dramatic outcomes everyone expected? If the world truly dumped dollars, you would see not only the dollar weaken, but also the price action in American assets collapse immediately and then keep collapsing. You would see Americans scrambling for liquidity. You would see no recovery. You would see the bond market break in a way that equity markets could not ignore. But that is not what happened. Stock markets still recovered. Housing did not implode the way people fantasized during every doom cycle. Even when the narrative was America is finished, the market kept finding buyers, so the money was not simply leaving. Something else was happening, and it is crucial. Now let us talk about bonds, because bonds are where the controlled panic lives. If you want to understand where capital is trapped, follow the bonds. When a currency weakens, it can be because buyers are hedging, because sellers are reducing exposure, or because currency adjustments are the cheapest way to move risk. One key clue from modern markets is that bond exchange-traded funds can quietly bleed out while equities stay supported. That suggests not a simple exodus, but a reallocation of pressure. Here is the mechanism in plain language. If investors decide they do not want to hold United States bonds anymore, they have to redeploy that money somewhere. But where does somewhere actually exist? If they think Europe is safer, they should buy European government bonds. If they think Europe is safer, European bonds should stop falling and start being bid up. Yet you can look at many parts of Europe and observe the opposite. Even high-quality European sovereign bond markets have periods where they do not attract meaningful inflows. And even when people claim Europe is the alternative safe haven, the price action does not always confirm it. So the question becomes ugly. If not Europe, then what? The answer is that some flows are not about buying a different country. They are about changing balance sheet constraints, hedging strategies, and the collateral that financial institutions must post. A bond sell-off can be a technical adjustment rather than a fundamental America is done verdict. And when you combine that with leverage, you get a system where the dollar can weaken without the United States collapsing, because the dominant players can keep liquidity and keep demand alive for the assets they need to support. And here is where 2026 reality sharpens the knife. In the last few years, AI has changed the labor market. It did not just remove jobs, it changed bargaining power. It made skill-based security look like a marketing slogan. For many workers, income volatility became normal. That drives desperation toward assets that still feel liquid. Meanwhile, governments and large institutions are managing risk through instruments that ordinary people never touch, and their decisions can produce price moves that do not line up with your intuition. Now, pattern interrupt. You are sitting there thinking, okay, but why would the system allow the dollar to weaken at all if it needs capital trapped? Great question. And the answer is even worse. Weakening the dollar can be cheaper than preventing flows directly. Think of it like this. If you want global investors to hesitate to exit, you do not always need to stop them. You can create a situation where exiting is expensive, messy, or psychologically difficult. A weaker dollar increases the visible cost of re-entering certain positions. It can also increase hedging costs for those trying to convert back into their home currency. When exits become expensive, panic selling does not happen at full speed. Capital trickles rather than runs. So what does the system do with the trickle? It feeds it back into markets where it can be used to support prices, maintain collateral levels, and keep the machine running. In the United States, the stock market is not just an economy thermometer. For major financial institutions, it is also a funding engine and a leverage playground. When equities stabilize, the system stabilizes. And stability keeps lenders comfortable, which keeps money moving. Now you might ask, but are you saying America is strong and everything is fine? No. I am saying the price signals are managed, and the suffering of ordinary people is not the metric that drives policy. The metric is liquidity, system survivability, and the ability to refinance without triggering cascading failures. Let me give you a micro story. Picture a 32-year-old nurse named David. In 2020, he watched friends learn to code and thought, finally, there is a path. But in 2026, he sees AI tools generate code so fast that entry level disappears. His shift pay rises a little, but his rent rises more. He starts using a credit card for groceries. He tells himself he will catch up when the market goes back down so he can buy in later. He checks headlines every night. He sees the dollar weaken by a reported amount. He assumes the United States is losing. He assumes he should wait for a real crash. Then he notices something. His retirement account barely moves down. It actually climbs. And his emergency fund, the part of his life that should be protected, buys less every year. So David feels trapped in a world where asset prices and human survival move in different directions. That is what a managed financial narrative feels like when you are the one living inside it. Now you want the mechanism behind why the stock market holds when the bonds look nervous. In modern markets, one of the most powerful levers is the ability to increase leverage while maintaining internal controls. Big institutions can raise leverage ratios, not by improving morals, but by changing balance sheet architecture, collateral haircuts, and risk models. When leverage rises, the amount of money that can be deployed rises even with the same capital base. That can support prices without requiring massive new foreign inflows. But leverage has a second consequence. It changes what happens when the exit door opens. If too many participants are leveraged, then normal selling becomes catastrophic when funding tightens or when hedging costs jump. You see this during stress events. You also see it during quieter periods, when prices float higher than fundamentals because liquidity conditions allow it. And here is a pattern interrupt with a punchline you will not forget. When a big bank increases leverage, it is not just taking more risk. It is manufacturing the appearance of money in the system. The cash is not magically created for everyone. It is created for the institutions that have the access, the credit lines, and the models that allow them to turn small amounts of capital into big market participation. So while you are told money is leaving America, insiders may be doing the opposite. They may be borrowing more, deploying more, and trapping more capital domestically. That domestic participation can keep the market afloat while foreigners hesitate or face barriers to exit. Now let us connect this to 2026's retirement crisis, because it explains why the system cannot afford a sudden collapse in broad asset prices. Many retirement accounts in the United States are still heavily exposed to equities and credit instruments.
Pensions are underfunded. Social Security is under pressure from aging populations.
People are forced to delay retirement or gamble on asset growth. So the state and the system have a strong incentive to avoid a broad, sustained bear market that would shred collateral, worsen funding gaps, and create political backlash. Now, global debt matters too. The world has exceeded $300 trillion in debt in many estimates and projections, with rising interest costs. When debt is that large, refinancing is everything. A crash is not just a market event, it is a refinancing event. It breaks contracts, it breaks liquidity, and it turns normal risk into chain reactions. Now, darker understanding, even if foreign investors reduce bond exposure, that does not mean they sell equities in panic. Often they keep their positions because they cannot easily unwind without suffering currency losses, mark-to-market losses, or because they face mandates and regulatory constraints. They might sell some, but they might also hold what is already embedded in their balance sheets. This is where the dollar weakening narrative becomes a smokescreen. It can be a way to prevent a full rush out. Instead of stopping the exit, the system makes it slower, more expensive, more uncertain. And once exits slow down, insiders can keep supporting markets with domestic leverage. Now, cliffhanger, you are probably wondering, okay, if money is trapped, how does the system still find the liquidity to keep equity markets rising? The answer is not a fairy tale. The answer is that global liquidity is being routed through specific channels that ordinary investors never see, and the routing changes when one pipeline constricts. In the years after major stress periods, central banks and large financial institutions became more dependent on international funding flows. When one region stops providing cheap money, another region can temporarily replace it. That means the blood transfusions in markets can shift locations. In this story, one region matters: Switzerland. Switzerland is small, calm, and historically viewed as a safe place to store assets. But in 2026, safe place also means stable funding source for global institutions with access to that plumbing. When other funding sources tighten, Swiss channels can become the alternative. If big institutions can borrow at relatively attractive rates and deploy that capital into United States assets, then you can see a continuation of market support even when the dollar narrative suggests stress. This also connects to why you sometimes hear that global investors hold large fractions of their assets in Switzerland. It is not because Swiss citizens consume all that wealth, it is because the structure is built for custody, stability, and asset management. Wealthy individuals, sovereign actors, and global asset allocators treat it like a vault. When global institutions need financing, they can tap that vault rather than forcing every decision through the messy public markets. So imagine the system as a set of pipes. If European bonds stop receiving capital, or if Japan reduces the ability or willingness to supply cheap funding, then another pipe can take on the function, and Swiss funding can become that substitute. The key point is that the substitute does not necessarily mean the underlying economic narrative is changing, it only means the funding channel is adapting. Now, pattern interrupt again. Let's talk about why currency movements do not behave like your schoolbook model. In your model, higher interest rates mean stronger currency. But in reality, currency markets often reflect hedging costs, capital constraints, and forced rebalancing. If big institutions have positions that are already funded, they can hold through currency weakness because the real problem is not currency direction. The real problem is whether they can refinance. Also, currency markets react to relative funding conditions. It is not just United States rate versus Europe rate. It is also how quickly other regions change rates, how much leverage is used to hedge, and how much inventory of risk exists in each market. When multiple systems reprice risk simultaneously, currency can move in ways that look irrational if you only track nominal interest rates. In 2026, AI influences this too. AI is not just replacing workers, it is replacing forecasting, trading, and internal risk monitoring. Institutions can react faster to market conditions, which can increase the speed of price formation and reduce the time for retail narratives to catch up. Retail people see a headline about dollar down. Markets see a change in collateral requirements and hedging flows within minutes. Now, here is the darker truth you probably do not want. The system does not need everyone to believe the same narrative. It only needs enough of the right people to behave in predictable ways. If enough investors hesitate to sell because they fear a forced exit cost, then prices can be supported without requiring massive new buyers. If enough retail investors keep buying into passive funds, then liquidity appears stable. And if enough institutions can increase leverage and manage risk models, then the machine can run with less external fuel. So the story becomes less about capital fleeing America and more about capital being managed. Now let's address the obvious skepticism. Some people will say, if everything is so managed, why do we still get crises? Because management does not eliminate risk, it postpones it and repackages it. The crash can still come, but the timing and shape can differ. Instead of a clean collapse, you can get prolonged stagnation for ordinary people while asset prices rise, followed by sudden stress when liquidity finally becomes too expensive. And that is where the retirement crisis becomes the moral disaster. In an economy where employment is unstable due to AI, and in an economy where housing is permanently detached from wages, people are forced to rely on financial markets to compensate. So when asset markets are stable,